Welcome to today's Explainer. We're diving right into a comprehensive investor briefing on one of the most fascinating players in retail right now, Ollie's Bargain Outlet. Look, if you've been watching the sector, you know it's a brutal environment out there. But while other physical stores are struggling or literally shutting their doors, Ollie's isn't just surviving, they're executing a massively aggressive growth strategy. So today, we're going to break down their unique operating model, check out their recent financial acceleration, and map out exactly why Wall Street is paying such close attention to their long-term growth runway.
Okay, let's dive into this. Everyone in America loves a bargain. You know, it's not just a catchy slogan for them. It is the absolute foundational ethos of Ollie's. Since they started back in 1982, they've built an empire on this one simple, universal truth. People love saving money. They're not trying to be the fanciest store on the block, right? Their model is laser-focused on offering goods at up to 70% below the prices you'd see at traditional, high-end retail stores. It's that simple.
If you've ever driven past an Ollie's, you've definitely seen their quirky, kind of Einstein-esque mascot and that bold promise right on the front, good stuff cheap. It's a really straightforward mission, but the execution behind the scenes, it's highly sophisticated. They're giving budget-conscious shoppers, and honestly, shoppers across all income brackets who just love the thrill of the hunt, real, brand-name household goods at massive discounts. It's a value proposition that thrives in pretty much any economic climate.
So to map out this investment potential, we've got a quick four-part roadmap for this explainer. First, we'll look at the moat, which is their business model. Second, the proof in their financial strength. Third, the runway of their massive growth strategy. And finally, the outlook on their market position.
All right, kicking things off with Section 1, the moat. Let's figure out what actually gives Ollie's its unique edge in such an unforgiving retail landscape.
The answer boils down to two words: opportunistic buying. This is literally the engine of their entire business. See, Ollie's doesn't just order the same inventory on a rigid schedule like a normal retailer. Instead, they use these deep, decades-long relationships with manufacturers and wholesalers to swoop in and buy up overproduced, overstocked, and closeout merchandise. Basically, when a vendor has excess inventory they desperately need to get rid of, Ollie's is the one they call. That lets Ollie's secure massive discounts and build their store assortment based purely on opportunity rather than obligation.
So the specific pillars making this model work are pretty rock solid. They combine those deep closeout discounts with their own private label goods in select categories, which gives shoppers a really consistent value. But the real magic here? It's how they mix this procurement strategy with a super lean operating structure. This combination allows them to sustain operating margins around 11.5%, which is fantastic. Plus, they're disciplined. They operate with a totally debt-free balance sheet. They're funding their growth entirely with the cash they generate, not by taking on loans.
Let's move to Section 2 and see how this builds into the financials, the proof. Because, let's face it, a brilliant model is really only as good as the numbers it puts up.
And looking at the recent year-over-year growth, the numbers are absolutely striking. We are talking about a 14.2% jump in net sales, which is incredibly strong for physical retail these days. But even more impressive, the bottom line. Adjusted earnings per share surged by 21.3%. What this tells us is that their top-line growth is highly profitable. They're not just moving more volume, they are efficiently dropping those sales straight to the bottom line for their shareholders.
So what exactly is driving this? Well, fiscal year 2025 was a total landmark year for them. They opened a record 86 new stores, bringing their total footprint to 645 locations across 34 states. That physical expansion, paired with really rigorous expense control and margin expansion, fueled that massive EPS jump we just talked about. And management is super confident this momentum is sticking around. They actually raised their EPS guidance for fiscal 2026, planning out 75 new stores and more strong cash generation.
Now, they're also driving some fierce customer loyalty through their rewards program, which is affectionately and honestly appropriately named Ollie's Army. It sounds kind of like a militia of extreme bargain hunters, but trust me, it's a massive financial asset. By offering exclusive shopping events and leveraging their co-branded credit card, they aren't just getting new shoppers in the door, they're significantly boosting the lifetime value of their existing base, basically turning your occasional deal seeker into a highly dependable repeat buyer.
Now, what's really interesting about this next slide is it brings us to Section 3, the runway. This is where the long-term investment thesis for Ollie's really takes flight. I want you to keep this number firmly in your mind, 1,300. That is management's stated long-term store target. Think back a minute ago when we noted they ended fiscal 2025 with 645 locations. That means even after a record year of growth, they are only at the halfway mark of their physical potential. There's a massive, highly visible runway right in front of them to literally double their footprint.
And the thing is, they aren't just throwing darts at a map to see where to build next. They've got a very disciplined, contiguous expansion strategy that feeds directly on the struggles of the broader retail market. Step 1. They identify retail consolidation, basically watching for traditional retailers who are shrinking or going under. Step 2. They acquire that distressed real estate through bankruptcy auctions or lease takeovers. And Step 3. They rapidly convert those spots to expand their own footprint. They are literally taking the industry's exits and turning them into their own hyper-growth opportunities.
A perfect example of this masterstroke happened recently, between late 2024 and early 2025, when Ollie successfully grabbed 81 former Big Lots leases. Think about the strategic advantage there. Instead of having to find raw land, deal with local permitting, and build a store from the ground up, they swooped in and secured 81 ready-to-go retail boxes. It's a brilliant move that essentially compressed years of growth into just a few months, supercharging their expansion instantly.
So, the crucial point is how this physical growth actually feeds right back into their business model. It creates this amazing compounding loop of scale. As Ollie's opens more stores, their buying power shoots up. When they can go to a vendor and say, hey, we can instantly distribute your excess inventory across 700 stores instead of 500, they get access to way larger, much higher quality deals. That better merchandise drives higher sales productivity per store, which generates stronger cash flow, which then funds even more debt-free store openings. It's a virtuous cycle. The bigger they get, the wider and deeper their moat becomes.
Moving to our final segment, Section 4, the outlook. Let's take a look at how the market is digesting all this data through both analyst sentiment and insider activity.
Wall Street is absolutely taking notice here. Recently, analysts at Jefferies upgraded Ollie's to a buy rating and bumped their price target up to $130. They specifically pointed out Ollie's strong market position, their highly resilient, recession-resistant model, and of course, that clear potential for long-term unit growth we just broke down. They're looking at a company that is perfectly capturing those budget-focused shoppers in today's economic climate.
And this brilliantly illustrates the valuation argument, especially when you compare them to peers. Historically, Ollie's traded at only about a 1x price-to-earnings discount compared to a competitor like Five Below. But right now, that gap has widened to roughly a 7x discount. For analysts, this widening gap is a massive opportunity. The argument is that as Ollie's keeps gaining market share, locking in these major merchandise deals, and executing their store growth, the stock is extremely well positioned to re-rate and close that valuation gap. Now, to keep things completely balanced, we do need to look at recent insider activity. Back in early April 2026, the executive chairman, John Swigert, sold a bit over 8,500 shares combined across a couple of transactions, priced around the mid-90s. While insider selling is definitely a data point you should always track, the context matters here. Insiders at Ollie still own nearly 5% of the entire company, showing they are definitely maintaining some serious skin in the game alongside everyday shareholders.
Which leaves us with the ultimate question as we wrap up this explainer. You've seen the opportunistic buying moat that consistently pumps out 11.5% margins. You've seen the flawless, debt-free balance sheet funding record store openings. And you've seen that tangible runway to double their physical footprint to 1,300 stores by basically feeding on the struggles of their competitors. So, the question for your own portfolio is this. As traditional retail continues to contract, is Ollie's bargain outlet positioned to be the ultimate apex predator of the closeout market? Take these insights, do your own due diligence, and decide for yourself if this growth story belongs in your portfolio.